Picture two men walking through Mayfair on a Tuesday afternoon. The first one, you notice immediately. The watch catches the light. The car idles at the curb with a badge everyone recognizes. He belongs to the club with the famous door, and he wants you to know it. For most of the last century, that man was the definition of British wealth. But in 2026, he's made a fatal mistake. He's visible. The second man you'd never look at twice. A plain, beautifully cut jacket with no logo anywhere on it. Quiet shoes. He drives something sensible. And he is the one who's actually rich. Quietly, enormously rich. And more importantly, he's the one the system can't see. This is the great stealth shift. Because here's the uncomfortable truth nobody at the dinner party will say out loud. In 2026, being loud isn't a flex. It's a tax liability. And while the truly wealthy have been busy disappearing from the radar, the rest of us have been quietly walked into a trap called fiscal drag. Your salary creeps up with inflation. The thresholds don't move. The personal allowance is frozen at £12,570. The higher rate still bites at £50,270, and that additional rate lands at £125,140. You didn't get richer, you just got dragged into a higher band while standing still. You feel it every single month. So why doesn't the person with £10 million seem to feel it at all? Let me introduce you to the reason they've all gone quiet. There's a piece of software sitting inside HMRC called Connect, and it doesn't sleep. Connect is a data matching engine, and it cross-references over 30 different sources at once. It sees the interest paid on your bank accounts. It reads the land registry, so it knows what you bought and what you paid. It talks to the DVLA, so it knows what's parked on your drive. And yes, it looks at your social media. Here's how it thinks. It builds a picture of your declared income, your PAYE, the number the taxman already has. Then it builds a second picture from your lifestyle, the holiday you posted, the registration plate in the driveway, the postcode of the house, and it lays one over the other. If those two pictures don't match, if you're living a £200,000 life on an £80,000 salary, a red flag appears on a screen in an office you'll never visit. That's the whole game now. It isn't about how much you earn. It's about whether your noise matches your numbers. So the wealthy did the only rational thing. They stopped making noise. The first move is to stop holding wealth as a person and start holding it as a company. Think of your money as a tree. Right now, most people grow their tree in the middle of a public field. Every gust of wind, every tax charge hits it directly, and everyone can see exactly how tall it's grown. That's you, holding investments in your own name, taxed at up to 45% as income. The wealthy plant a different kind of tree, a deep-rooted oak, in a private, sheltered valley where the wind barely touches it and no passerby can measure it. That valley is called a family investment company, a private company that holds the family's investments. And here's why it's so quiet. Profits rolling up inside that company aren't taxed at that 45% top rate of income tax. They're taxed at the corporation tax rate, and even at the top end, for profits over £250,000, that's 25%. The money isn't landing on a person the system is watching. It's compounding, sheltered, inside a structure that just looks like a dull little company at Company's House. The oak grows in the valley, and Connect sees a field of grass. Now, the second strategy is the one that quietly funds the entire quiet luxury lifestyle. And once you understand it, you can't unsee it. The rest of us fund our lives by selling. You sell some shares, you take the gains, and the moment you do, capital gains tax taps you on the shoulder. Selling is a taxable event. Selling is noise. So the ultra-wealthy simply don't sell, ever. They follow a pattern advisors quietly call buy, borrow, die. They buy the assets, the shares, the property, the company. Then, instead of selling to raise cash, they borrow against them. It's called a Lombard loan, a portfolio loan, and the bank is delighted to lend against £10 million of assets at a low rate. That borrowed money is cash in their pocket. And here's the part that matters. Borrowed money isn't income. There's no capital gains tax on a loan. There's nothing for Connect to flag, because on paper, no income arrived. They live on the loan, the assets keep growing behind it, and the die part, that's for the next chapter. This is how someone funds a genuinely lavish life while showing an income on paper that wouldn't raise an eyebrow. They're not spending money, they're spending access to money. And this brings us to inheritance tax, the 40% charge that sits waiting at the end of every estate. Once you're past that frozen nil rate band of £325,000. For years, the quiet play here was the AIM market. You'd invest in qualifying smaller British companies, hold the shares for the magic 2-year period, and business relief would wipe the inheritance tax on them clean away. 2 quiet years, and a slice of the estate simply vanished from the 40% charge. But 2026 is the year the government came for that trick. From this April, AIM shares no longer get that full relief. They've been cut to 50% relief, which means an effective 20% inheritance tax charge where there used to be nothing. The taxman found the quiet door and half closed it. So watch what the truly wealthy did. They didn't panic. They went deeper. The full 100% relief still exists, but now it's aimed at genuine, unquoted trading companies, capped at a combined allowance of £2.5 million per person. So the smart money stopped buying quiet little AIM tickets and started owning quiet little businesses instead. Real trading companies, held for that same 2-year period, tucked neatly inside the band that still disappears from the 40% charge entirely. The strategy didn't die, it just got quieter and it got private. So what does all this invisibility actually look like, day to day? It looks like almost nothing. That's the point. The clothing is bespoke and utterly unbranded. A jacket that costs a fortune and whispers it only to the 3 other people in the country who'd recognize the cloth. The children go to the best schools, but the fees are paid through a trust, not a payslip. So there's no salary spike for anyone to notice. And the homes? From the road, it's a farmhouse. A nice one, sure, but it reads as comfortable, not loud. What you can't see from the lane is that the house isn't owned by a person at all. It's held through an offshore entity, a company, a structure, so there's no name on the deed for Connect to match against a lifestyle. The oak is in the valley. The valley has a hedge around it, and the hedge looks like an ordinary field. Now, hold that image next to the person earning £80,000 a year. On paper, that person is doing brilliantly, top 10% of the country, and yet they feel broke, properly, genuinely squeezed. Why? Because they're completely visible. Every pound is PAYE. Every pound is taxed at the source, at the higher rate, before it ever reaches them. Their savings sit in an ISA that helps at the edges, but was never designed to hide anything. They're playing the game entirely in the open, with the referee reading every move. Meanwhile, the person with £10 million sleeps soundly, not because they've broken a single rule, but because they're structured. They're a company, a loan, and a trust wearing a farmhouse. One earns and is seen, the other holds and is invisible. Same country, same tax system, 2 completely different realities. And 2026 pushed this even harder, because this is also the era the famous non-dom status finally died. For 2 centuries, wealthy internationals could live in Britain and keep their foreign money outside the UK tax net. That door is now shut. In its place sits a stricter, residence-based system, a 4-year window on foreign income and gains for genuinely new arrivals, and then full worldwide tax, like everyone else. You'd think that would catch them. Instead, it did something else. It taught the truly wealthy that visible, named, personal wealth is fragile, that any status can be abolished in a single budget. So they stopped relying on who they are and moved into layers that don't care about labels, companies, loans, and trusts. The rules got tighter and the money simply moved somewhere the rules couldn't easily follow. So here's the lesson underneath all of it. Call it the signal and the noise. The loud man in Mayfair, with the watch and the badge, and the famous door, is broadcasting a signal. And in 2026, that signal goes straight into a database that never blinks. He isn't the winner of this game. Very often, he's the one paying the most tax in the entire room. The quiet man is transmitting nothing. No logo, no spike, no flag. And in the silence, he's doing the one thing this whole system rewards. He's building a legacy the taxman simply can't see. In modern Britain, wealth stopped shouting. It learned to whisper, and the quietest person in the room is very often the richest, precisely because you'll never know it. If you learn something, Don't forget to like and subscribe. See you in the next one.